Hi, everyone. Thank you for joining us today. I'm Marche, the Director of Webinars at Advice Chaser. I'm so glad you're here. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we don't get to it, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to today's moderator. Let me put his picture up here. Michael Hart is the CEO of Hemispheres Investment Management, a global investment management firm he founded in 2014 that manages both equity and balanced account portfolios for individuals. He has over 34 years of capital market experience. From 2007 to 2013, he worked as managing director at Tradewinds Global Investors, where he was a global equity and emerging market equity portfolio manager and a global securities analyst. Prior to Tradewinds, Michael founded and operated Hemisphere Asset Management from 2000 to 2007. The firm managed global equity, fixed income, and balanced accounts for individuals and institutions. From 1989 to 2000, he helped manage the investment portfolios of the Farmers Insurance Group of companies as a senior portfolio manager. During this institutional tenure at Farmers, Michael spent 8 years working as a portfolio manager of emerging market debt investments and 4 years as a portfolio manager of international equities. He helped increase the value of the insurer's international investments to over 1.1 billion from approximately 50 million. He also received awards of merit for generating outstanding returns as a portfolio manager of foreign fixed income and equity investments. And Michael, why don't you go ahead and say hello?
Marche, thank you very much for that nice intro. Hello, everyone. And I always enjoy participating in discussions about investments, especially when it's such an important topic as retirement savings.
Well, thank you so much for being here. Michael will be our moderator. And so I do want to encourage you to put your questions in the chat so that Michael can make sure our presenter knows about those, and we can have a very informative educational event today. So I'm going to introduce you to today's presenter. Connor P. McDevitt, CPFA, is with EP Wealth Advisors. He has been working on corporate retirement plans since 2011. He enjoys helping clients set, work towards, and meet their retirement plan goals. Prior to joining the EP Wealth team, he was the regional sales manager at Century Insurance and Lincoln Financial Group. Originally from Philadelphia, Pennsylvania, he is a graduate of Virginia Tech, where he majored in personal financial planning and managed the men's basketball team. In his free time, Connor participates in Acing Autism, a nonprofit teaching children to play tennis, and is active with the Virginia Tech Alumni Association in Los Angeles. He also enjoys spending time on the golf course, beach, and of course with family and friends. And we're very excited to have you here today to present. So I'm going to go ahead and stop my share here, and you can share your screen, Connor, and we'll get going.
Thanks. All right.
Take just a second, folks, while we get this. This is live, and so that's what happens in live events.
Sorry about that. Where?
No worries. Do you want me to go ahead and share, and then we can just go off of my screen?
There we go.
Oh, we got it.
Got you right here.
Awesome.
Everyone see that all right?
We can see it.
Yes.
Excellent. All right, well, we'll get started today. Again, my name is Connor McDevitt. Nice to be with everyone here today. And what we have on the agenda is to discuss the 2021 retirement plan, some updates that are going on, what fiduciary roles and responsibilities there are within retirement plans you should pay attention to. And then lastly, CalSavers, which is a new state-run program, which is essentially requiring business owners to either start a retirement plan or enroll into the CalSavers program. So there's a few good things to discuss coming up today. All right, so getting started. So for the 2021 updates, just like last year for 2021, the same employee deferral amounts remained the same. So if you're under 50 years old, the most you can hold from your paycheck is $19,500. And if you're over 50, you can do what's called a catch-up provision, which is an additional $6,500, bringing your total to $26,000. So again, these are the numbers that you're able to contribute out of your own paycheck into the retirement plan. Now this year, the limit increased to $58,000 or $64,500 for both employer and employee contributions. So for you all as business owners, you can defer out of your own paycheck and then also pay yourself as an employee coming from the employer money. And so this limit, $58,000, is if you're under 50, and if you're over 50, it's $64,500. So again, this is for both employer and employee contributions. Probably one of the biggest things that's happened in the industry as of late is what's called the Secure Act. And this was passed due to COVID, and this actually extended the deadline where you're able to start new plans to do employer contributions and still fund for the previous year. So actually right now, you're still able to open up a profit sharing plan or a defined benefit cash balance plan for 2020 and still fund it. Usually you would have to sign paperwork and open the plan by 12/31, but due to COVID, they actually extended that to tax filing deadline plus extension. So again, I know most businesses, it's either August or September. As long as you filed an extension, you still have the opportunity to open up, again, either a profit sharing, cash balance, defined benefit plan, and still fund for last year. Again, this is just employer contributions. It's not 401k deferrals. Those need to be done within the same year that the deferrals are taking place. So this, again, is just for employer contributions into the plan. All right, now we're going to discuss some fiduciary roles and responsibilities that you would want to be aware of, and some essentially what are called options where you can shed the fiduciary liability, if you will. So again, if you're a business owner, the fiduciary responsibility when it comes to retirement plans, you need to act solely in the best interest of the plan participants and their beneficiaries. You need to act for the exclusive purpose of providing benefits to workers participating in the plan and defraying reasonable expenses of the plan. And lastly, carrying out duties with the care, skill, prudence, and diligence of a prudent person familiar with the matters. So I know that's a lot of jargon, but in short, as the business owner, if you have a retirement plan, you need to act in the best interest of the employees. That is who the plan is for, and that is who we're trying to essentially provide the benefit for. Now, as a business owner, there's no way for you to completely remove yourself as the fiduciary for a plan. You own the business, so naturally you are going to be a fiduciary. Now, there's ways where you can limit your fiduciary exposure, and one of them is called by adding what's called a 316 plan administrator. So the way 316 plan administrator works, they handle all of the annual 5,500 filings, and they handle all of the distributions, any loans. Right now, if you have a plan and you have to sign off on the 5,500 each year, sign off on distributions, on loans, if you add a 316 to the plan, they essentially do all of that administrative work for you. So anything admin-wise you do now. If you add a 316 to the plan, you can remove yourself from doing any of that work. Now again, selecting a 316 fiduciary is in and of itself a fiduciary act. So again, there's no way for you to hire enough people where you remove yourself, but they essentially, the buck stops with them when it comes to any administration work that needs to be done for the plan. That is essentially what you would be paying them for. Again, this is typically a service that most providers have. It's an additional cost. Essentially, it's just outsourcing this work.
Connor, we have a
Yes.
question here.
Excellent.
The question is, how long does it take to set up a retirement plan for your company?
So it's about 6 weeks or so. I'll go back to this for a moment. And typically the process is really to start it up. You need census information so they can build participant accounts. There's typically about an hour phone call where we review all of the plan specifications. So we discuss eligibility. How frequently do you want employees to become eligible? Vesting. Is there going to be some type of employer match? So that all goes into the hour phone call. So I'd say it's about 2 hours of a business owner's time, and it's about 6 to 8 weeks to just get the plan documents, to set up the website, build employee accounts. There would need to be some education and enrollment meetings going on to let everyone know, here's what the plan is about, here's why you want to participate, here's specifics, etc. So again, from a time perspective, 2 hours, and again, it takes about 6 to 8 weeks to get everything up and running. Depends on when your first payroll is, like to link that up so all of the dates kind of coincide with each other and everything flows smoothly. So,
and as a follow-up to that, does a 316 plan administrator have to be an employee of the company?
No, so great question. So the 316 would actually be an outside party. So if you think about a retirement plan, we work with a lot of business owners here, and most of them have someone at their company, maybe their CFO or HR director, someone who manages the plan. So they're the plan administrator per se, and they might be the ones that sign off on the loans in-house. But when you hire a 316, you're going outside of your company to bring someone in to do that work for you. So again, I guess if you take away the 316, if you just look at plan administrator, that would be somebody at your company that works for you that's managing your plan on a day-to-day basis. If you wanted to loop in a 316, again, that would be an added cost, someone outside the firm to come in and do that.
I don't think we have any more questions. You want to move on to the next part?
All right, absolutely. So the next type of fiduciary is called a 321 fiduciary, and this is what is essentially on a majority of retirement plans. And the way this works is, from an investment standpoint, the investments should be looked at least on a quarterly basis, right? If you think about how often the market changes, if you go back to COVID in 2020, a lot of things were going on. You want to make sure that there's a process in place to review, monitor, and change funds as needed. The Department of Labor and the IRS aren't concerned necessarily about performance. They want to see that there's a process in place where the business owner is looking at the performance and looking at the funds to make sure that the best possible fund lineup is available to their participants. Now, in a 321, essentially the liability and responsibility falls on the business owner. And that's a big misconception in the industry. A lot of business owners think if you have an advisor on the plan, he or she is responsible for doing the investments. And while that may be true, while they might provide recommendations, if the business owner is the one signing off on those changes happening, you are responsible for the lineup. And let's say an employee were to bring litigation, you would be responsible for providing that justification. It would not be your financial advisor. And so that's certainly something to consider now. Again, if you have a plan, think, when's the last time I've looked at my funds? And if someone helped me look at my funds, was I signing off on those changes, or were they just implementing them? And I'll discuss really what that difference is here momentarily. But again, for anyone who has a current plan, that's really what you want to think about. From a retirement plan issue perspective, the biggest one is funds and the cost of those funds. And the second is administration, just making sure you upload your contributions on time. But I'd say probably 90% of issues arise with the fund lineup and what's available. And again, typically it's larger companies. If you go to Google and type in, large corporation 401k fee, you'll see there's plenty of instances where employees brought suit because they thought that the fees that they were paying in the fund lineup were too expensive. And a lot of times it has to do with if you have one company that is the provider and you also use that same company's funds, essentially it's double dipping. They're incentivized to put their own funds in their lineup, and sometimes they're too expensive. And there's plenty of class action litigations and lawsuits going on where it could be billions of dollars are coming back to a group of employees because their employer was not making the best decision in their best interest. All right, and so again, that's what a 321 is. Now, the higher level of that fiduciary is called what's a 338. And really, the way I think the difference is if you get in a car and you don't know where you're going, you put it in Garmin, but you're still operating the vehicle. Garmin tells you to go right, you go right, but you're driving the car. So that's a 321 because you're still making the decision. Someone's helping you get there, but you're doing it. In a 338, you're sitting in the back of an Uber, the driver is going, you're not concerned about anything. That is what a 338 is. And that's when you're just similar to the 316 with admin, you're relieving yourself of any responsibility when it comes to the fund lineup. And that's what most business owners think they have, but they don't. And so you want to make sure, and this is a question that I have our business owners ask all the time, is if we're changing funds, who's going to be signing off on those? And a lot of times it comes back, you need to sign off as the business owner. And so you want to make sure that ideally the plan you have in place, that the provider you have offers this higher level of 338, where if anyone was to bring litigation, my portfolio management team would be able to provide the justification as to why this is the lineup we have, these are the funds, why we have them, and again, just take that responsibility off the business owner's plate. Because again, you all as business owners, you're focused on the business. Retirement plans are always a back burner issue until something comes up. So it's how do we make sure it's in the best state to avoid any possible issues now and moving forward. And again, having a 338 is a very important feature and tool that you can add to the plan.
Thanks, Connor. And we have a couple of questions here. First, what sort of insurance should business owners have to protect them in case litigation when it comes to these plans? And the second is how can I figure out if we're being overcharged for fees?
So for the first question, all retirement plans need what's called a fidelity bond, and it's 10% of plan assets. But what that does is it protects the employees from the employer doing something mischievous with their money. And so that's why as the employer, you pay for that fidelity bond that's at least 10% of assets to cover the employees, from you per se. The only thing that you could do to avoid having the responsibility on you would be to hire a 338 investment manager, whether it's at a cost or part of the service that they provide. Typically, that's the only way that you can remove yourself as the fiduciary on the fund lineup. Short of having that agreement in place, again, if the IRS, Department of Labor, were to knock on your door, you should have justification as to why this lineup was chosen. Here's how we review, monitor, update as time goes on. Again, I see plans all the time that haven't looked at funds in 2 or 3 years. You think about what's changed between 2018 and right now, you would think that something else would have changed in the lineup. And so it's just having an extra set of eyes on the investments and just, again, letting you all focus on managing the business. And the second one, I'm sorry, was?
Can I figure out if we're being overcharged for fees?
Yes. So there's a way In terms of running comparative analysis, I mean, it's something that's certainly able to be done. Each plan have fee disclosures. One's called a 408B2. That's a planned fee disclosure. Another's called a 404A5. That's a participant fee disclosure. So if you have those two fee disclosures and there's a competing bid, there's certainly ways to figure out who's paying what and how much it costs. And again, with retirement plans, it's never easy. You won't ever find it on one page. I look through 20-page documents and scan, and I wish it was much easier. And so once we have the information we need, there's tools to put in place to say, here's how much the employees are paying, here's how much the employer is paying, and really line by line, cost by cost. And again, once you have that, it's much easier to make decisions. And again, a lot of times you won't see line items coming out on your account. You could be paying over 1% in fund costs. So while you don't think you're paying that much because you don't see money coming out of your account, it's costing you an arm and a leg to invest. And so there's ways that the money, there's ways that you can be overcharged without necessarily knowing it. And so, yes, there's certainly ways to look at, here's your current situation, here's another situation, and just compare and contrast the two. But fee disclosures would be needed, as well as a competing bid, if you will.
And another question is, how often should the lineup be reviewed?
So I work at a firm, we're the 338. It's quarterly. So every quarter, I get a note from our portfolio management team, change fund A with fund B, or no changes, whatever the case may be. So it should be looked at least that frequently. We changed 4 funds in 2020 and one so far in 2021. So it's not like huge overhaul. We're changing 10 or 12 funds at a time. It's trying to find the soon-to-be rotting apple as it's getting there and plucking it out before it's worst in class. And so it's just identifying, we have a watch list. Once it's been there 2 or 3 quarters, then it's off. And so, again, it's not overhauling 30 funds each time. It's just 1 or 2 each quarter, if that. And so, again, frequently enough, and as you all know, the market goes up and down. And from a retirement perspective, we're not necessarily concerned about how the market did in a 6-month or even 1-year time frame. If you look at retirement plans, some people will have these for 40, 45 years. So we just want to make sure that there's a solid set of funds in there to stay invested in, to get your consistent growth over time, and just trying to eliminate the bad apples in there.
Thank you. We don't have any further questions at this time.
Excellent. All right, so as I mentioned, California is one of a few states. I know Illinois is new to the table as well, but there's a strong push to allow, essentially there's a lot of employees, I think there's 17 million or so in the state of California that did not have access to a retirement plan. And so CalSavers was brought on to, I think, number one, help push business owners to start plans. There's a lot of good tax credits you can get. You can get up to $5,000 for the first 3 years, so $15,000 total if you're a small business owner starting up a plan. And so whether it's starting up a plan or opting into this CalSavers program, it's just a way to help drive employees into start saving for retirement. And so depending on how many employees you have, and we'll hit on this on the next slide, but there's dates that you need to start the plan by. And again, it's like a Roth IRA, and so the same Roth IRA limits apply. So if you make over, I think it's $140,000 solo, or you and a spouse, I think it's $250,000 or so, you cannot contribute to a Roth IRA. And again, CalSavers, it only provides for employee payroll deductions, and there's no employer contributions. And because it's an IRA, the max you can do is $6,500. And so here is these are the mandated dates. So as you'll see, if you had 100 or more employees, you needed to start this, what was June 30th of last year, but they bumped it up to September due to COVID. So we've already passed this. So if you're on the call, you have 100 or more employees, and you don't have a plan, we should definitely get on that, either starting one up or opting into CalSavers as soon as possible. If you have 50 or more employees, your cutoff is coming up this June 30th. And if you have 5 or more, it's by next June 30th of 2022. And so again, you either need to start up a 401k or enroll into CalSavers, and you can find them at calsavers.com. And so here's some administration. Yes, sir.
Sorry, what happens if a firm doesn't comply with the CalSavers requirements?
There's a lot of fees. There's daily fees that you're charged. I can pull up the specifics, but it's a certain amount of dollars per participant per day that you're charged if you don't do it. And so you're certainly strongly incentivized to do it. Yes. So I can certainly get exact figures, but it's not something that you want to disregard.
Thank you.
Absolutely. So I have been pushing our business owners away from this really just due to the administration tasks that you would need to do as the business owner. It's all on you. There's no advisor to help or anything like that. The business owner is required to track all eligible employees and offer them within 30 days of their hire date. If they do not make an election, they essentially need to be auto-enrolled into the plan, and then you'll start deducting from the employee's paycheck without them essentially knowing to start. They're also required to track and escalate by 1% each year, each January 1st. And again, in addition, you'll be required to track all eligible employees who opted out of the program at least 6 months prior. So it's just a lot of consistent follow-up. It's all on you to track, to deduct, to put into the plan. Again, it's only $6,500 that the employees can do, and so it's just certainly something that I've been suggesting. Open up a shell 401k plan, turn on the employee deferrals, and it's going to be easier administratively wise than it would be to continuously track through the CalSavers program.
No questions at this time.
All right. So the last few slides here is really just integrating, how do we integrate your retirement plan with your personal plan? So there's just a lot of different ways that you can utilize a retirement plan, whether it's a simple and SEP all the way up to cash balance, profit sharing, 401k safe harbor, whatever the case may be. And so again, this retirement plan is a key tactic to both your personal and business, and as we take this holistic view. So from the business planning side, these are all, we can think about the tax planning, retirement planning, employee benefits, all of these different management and analysis, and you couple that with, from the personal financial planning standpoint, cash flow, investment, again, the same analysis, retirement, divorce, and estate. And essentially what we do is we utilize the plan. And as you'll see here, so this is just an example we did about 2 years ago. In S Corporation, there's Nathan, who's the client, will say, and then his partner, this is how much they're both making. Right now, Nathan's federal income taxes are $165,000, and he's only getting $13,000, or both of them are getting $13,000 total, $6,500 each into an IRA. Now, what we've suggested doing is utilizing a retirement plan, a cash balance plan. And so now, if you look at this, their 401k, we did a 401k cash balance plan. So now they're each able to do what would now be $26,000, what was back then $24,000, and then also put another $400,000 of employer money into the cash balance plan. Again, this is coming from the company, and this is $400,000. And now, and 80% of that, 79%, is going to Nathan, our client. And what does this do? Well, utilizing this, he's able to put $400,000 in, and that drops his federal income taxes from $165,000 down to $42,000. It's about $120,000 in tax savings alone, while also contributing about $450,000 into the retirement plan. So again, these are just methods and ways that we can integrate your personal plan with the retirement plan to make sure we're utilizing and maximizing your total benefit.
Connor?
So with that, yes.
Yeah, I have a quick. So what the examples you've provided so far seem to be directed at full-time employees. How are part-time employees covered, or are they?
So from a retirement standpoint, there's eligibility requirements. And so typically those are, you have to be 21 years old. The lowest is 18, is the lowest you can make that, but typically it's you have to be 21, 1 year of service, which is counted as 1,000 hours. And so there's ways that you can make the eligibility. Typically, part-time employees are not included in the plan. Same with any contract or leased employees, things of that nature. They need to be, full-blown, full-time employees of the company, working full-time hours. But again, at the end of the year, part of the compliance process is we get the year-end census. So, here's how much Joe Smith worked hours-wise, here's how much he made wages, and everything's run through the system to make sure that all of the numbers add up. Any contribution he was supposed to get, he received, any deferrals, et cetera, all of that. So, but again, typically part-time employees are not included in the plan unless we've had business owners drop that to full-time employees, working 1 year, and they'll call that 500 hours. Let's say they want someone who they know works 600 to be in the plan, they can drop that number to 500 or whatever they want. So there's ways that you can tweak eligibility, but there are maximum requirements allowed.
All right. Thank you.
Of course. All right, well, that's all I had for this afternoon. I don't know if there's any additional questions. CalSavers, retirement plans.
Yeah, we have another question. How do you integrate the 401k into the rest of your benefits?
Yes, so there's a few different ways to do that. I get asked that question pretty frequently, and the most, I'd say, frequent one I get is regarding payroll, because a lot of times they like to have the integration between the payroll deferrals as well as the 401k, so those systems link up. So depending on your provider, there are ways to set up, whether it's HSA integration, payroll integration, full benefits. I'm sure most of you have heard of ADP and or Paychecks. There are certainly additional firms outside of those that offer the same integration and the same tools. And so if it's something that you're looking for, especially if you're a growing company where you either have high turnover or you're hiring more employees, it really is a benefit to integrate and automate as much of that process as possible. That way, again, as much work is taken off your plate as it can be.
It's another question. They're asking whether there's discussion regarding the California law on CalSavers that would be overturned or further delayed. Is that a possibility?
So, not that I have heard of, and again, we've already crossed the first threshold with 100 or more. We've got the 50 or more coming up this summer. As far as I've heard, it's all green ahead, so I have not heard anything pending litigation that would put a pause to that. I think most companies were pretty warm to the idea, and again, we've seen a lot of startup plans come because of this, just due to the fact that most employers don't want to deal with the administrative headache that comes with CalSavers. And so, again, it's just adding a benefit that is only maybe $2,000 to $3,000 a year in cost, so it's not a huge cost to the employer, but the benefit certainly outweighs what that is. And so I think just as much as offering it, it was helping to start new retirement plans. So as far as I know, if you have over 50 by this summer, you need a plan or you need to opt into CalSavers.
All right. And one more question. Could you please briefly describe what a fiduciary is?
Sure, absolutely. I can jump back to the slide as well. So there's a few different types of fiduciaries. If you are a business owner, you're a fiduciary. Just naturally by you owning the company, you are a fiduciary. So you always need to act in the best interest of your employees. That goes for anything, whether it's the plan or any other facet of the business, right? You as an officer of the company are a fiduciary. Now, from there, the business owner can essentially, what's the word I'm looking for? Move responsibilities onto others if he or she so chooses. Now, let's say they push the deferral, the contribution uploads to the office administrator. And so every 2 weeks when everyone gets paid, the office administrator uploads the contributions. That that office administrator is not a fiduciary. That's just a task that they do. At the end of the day, the business owner is the one responsible. From adding an additional fiduciary, if you will, as I mentioned, there's the 316, so they handle the administration. So in this setting, you have the business owner who's a named fiduciary, and then if they want to remove themselves from any responsibility or liability, they would need to hire an outside party. They can't just move the work on to one of their employees. That doesn't remove themselves from the responsibility that comes with that. They would need to hire, again, an outside party. We have larger plans where there's 3 or 4 fiduciaries. You have the business owner, you have the CEO or the CFO, there's a controller who is the day-to-day contact who signs off on loans. Really, if they're an officer of the company who has a day-to-day contribution to the plan, they're most likely a fiduciary. Again, if it's just an office, admin support, someone who just does the contribution uploads or communicates information to employees, they're not a fiduciary. That's really saved for the officers, the highly compensated employees, the owners of the firm. And then again, if you hire an outside entity such as a 316 to handle admin or a 338 to handle the investments. In this instance, so if you're a business owner and you hire a 316 and a 338, you hired someone to do the admin, someone to do the investments, there really isn't much for you to do, but you're still a fiduciary because you hired, hiring fiduciaries is a fiduciary act. And so, again, you can never remove yourself from responsibility, but if you hire the correct people, you can drastically reduce what you're liable for.
Thank you very much.
Of course.
Do you have any more questions at this time?
I believe we just have another question come in.
Okay, yeah, here we go. How often should a business owner review the plan?
Great question. Every 2 years or so would be every 2 to 3 years. And again, it's getting a pretty easy report done of here are my fees, and you bid it out and see what else is there. And again, it's lowest price doesn't always win, doesn't always have to win. I never go with the lowest price because that means they have the worst service. So it's finding a happy medium between what are you paying and what are you getting for it. And so it's not like you have to bid it out and save $10,000 or save $1,000 and move. It's, hey, I got a bid and it was $500 less, but I don't feel comfortable. And again, as long as you're going through the process of seeing what's out there and making sure that, again, you're in the best interest of the employees, that's really what it comes down to, is making that effort, if you will, of just making sure that what everyone's in is in a horrible situation. And unfortunately, you don't know that until you have a discussion about the plan or review the plan with someone who knows about the plan.
Thank you. I think that's it for questions.
I think that covers the questions that we have right now. I want to say if those of you who we didn't get to questions, I'm just going to go ahead and share my screen here, Connor.
You got it.
If anyone else has questions during the outro, you're welcome to type those in the chat. We will reach out to you if we haven't had a chance to get to them. So on behalf of Advice Chaser, we want to thank our speaker today, our moderator. Thank you, Connor. Thank you, Michael. Thank you for educating us and working with us to bring you this webinar today. Thank you to our attendees for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends, family, and colleagues, other business owners as well. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, sorry about that. Thank you so much for coming. We will see you at another webinar soon. And have a great rest of your day.
Thanks, everyone.